But what I wanted to go over today, guys, is in a way like this Government 2 chapter is all about some of the intricate pieces of governmental reporting, really like the nuanced technical things that is going on in governmental reporting. So this chapter 17 really deals with about 7 topics. There's 4 or 5 general governmental accounting topics that we're going to talk about, and we're going to cover that in the second half. And then there is just an overview of a full governmental report, and then there's an overview of a full university report, right? So I want to go over that in a way. I'm going to do it a little bit backwards. Do it a little bit backwards in a way of what we're doing is we're going to go over landfills, capital leases, pensions, and historical treasures, and how to account for them using governmental accounting. And that's sort of the technical aspect using the journal entries. And that's going to be in the chapter that I want to go over in the second half with you guys. And then a lot of these things, in terms of the second piece of this chapter, is about the structure of a governmental report. Basically, the whole report and what it looks like and what's in it. And that's called the full governmental report. So what I decided to do, in a way, is first, I gave you guys the Rutgers University June 2013 ending financial statements, audited by KPMG. So you guys have that, and you guys have the 13 questions in front of you. And what we're going to do is we're going to go through this now, kind of page by page, and I just want you guys, in a way, to just be curious about what are we going through and what is going on in this report. You know, one from, an accounting perspective, but honestly, mostly from the subjective perspective of what is the management and discussion analysis all about? What are these notes that are financial statements? What are they really saying, right? And I think in this context, when we get to the chapter, when you get to the book, you also have quite a reference point to what is being discussed as a real example to what's going on. So what we're going to do is, in a way, today is going to do about a half an hour right now of just an overview of this report. I'm going to go over the report with you together about a couple of things that I found interesting about the report. I was really reading. I thought a lot of different things were really popping out as I was reading this financial statement. So I'm going to share that with you as you go through it. And then I'm going to go over the PowerPoint for about 15, 20 minutes just to kind of solidify the concepts more like theoretical. And then I'm going to give you guys 15 minutes to complete the sheet that you guys have, the 13 questions. And this is to give you credit for class participation, attendance, things like that. I think in a way I haven't really been recording attendance on like a real name by name basis. But I am making up for that by actually giving the extra points to people who are here performing the work. So this work you'll be handing in, I'm going to basically look at it, grade it, process it, and update the points based on that because you guys are here. And that's going to, in a way, average out so that 5% is indicated by who's been coming by the kind of product that they're giving me. So I appreciate you guys getting together and do it in your group. You know, you can do some of it now. I think it probably is now is the best time to do it because we're going to be going over the report, like line by line. But I think what you put together, share it with your group when you guys are meeting in 45 minutes so you guys can complete it a little faster. I don't know if some people from the other class are still working on it, but it's not meant to really, don't let, it has to be perfect, take over and, stay here for hours. It doesn't have to be perfect, but if you do your best also. So I wanted to go through the Rutgers report, and the first thing I noticed, first thing I'm noticing is, I'm just being curious about this, is we have KPMG as the auditor, and right away you see here, in terms of the audit opinion, I always try to read the audit opinion, especially because I remember whatever it says in the audit opinion, you want to read really carefully because it really shows you what's going on with the financial. And the first thing you want to understand is like, is it a qualified opinion or is it a clean opinion? Really, right away, you want to know, is this, are there any issues, and how do you know? Basically, they're saying that everything is stated in accordance with generally accepted accounting principles, so there's no qualification at all. So it looks like a clean report. It's the first thing quickly you want to get an understanding of, if there are major issues, that would be the place you would find them, right? And now they're talking about also, I wanted to focus here on the type, because the opinion discusses the type of statements that are being opined on. Because the auditors, they're very tricky. They really state what is exactly that they're doing very precisely and what they're not doing. They're very good at that, right? Just like lawyers. This is what we're doing. This is what we're not doing. So basically, the statement of net position we're opining on, right? And the related statements of revenues, expenses, and changes in net positions and cash flows. And the related notes. So remember in audit, whatever it says in that paragraph, that's exactly the scope of operations. So those are the three statements that we're dealing with. And just to show you, that would be in GAAP language, the balance sheet and the statement of operations and the statement of cash flows. So you see the difference here. It's the statement of net position and the statements of revenues, expenses, and changes in net. So this basically gives you the flavor of how we're different right away from GAAP. So it's one thing to sort of think about. Then there's some other things here regarding an adoption of a new financial statement, of a new accounting pronouncements, GASB number 61 here, and GASB number 65. And we're saying, although there was a specific restatement regarding these accounting pronouncements, retroactive application of these restatements, the opinions are not modified regarding this. So this is good news, that in a way we're saying that, we had some issues, regarding these new accounting pronouncements, but it's nothing outside of the ordinary scope of operations. So it's just really explaining what's going on. And then we're talking about, in this piece, it's really interesting because, you really find out information and you can learn about any kind of entity by reading these type of things, the MDMA. So this is the management discussion and analysis. And, what pops out at me here is that Rutgers has 28 different schools, undergraduate, 18 graduate programs. They have 6,000 acres in 12 counties, right? And then there's a whole paragraph about One Washington Park. It's a whole thing here in One Washington Park. There's a corporation that runs it, and then there's a building that they created, and a separate unit that is in charge of this whole thing to serve it. So I think it's interesting what's going on. I think it's clear that even in the big scheme at Rutgers, One Washington Park is like a big deal. It's a kind of a project that they're working with, and you'll see there's a lot of language about different things that are going on with One Washington Park. Now, getting to the pie chart here with revenue, I was really surprised that student tuition is only 32% of revenue. Wouldn't you think it would be more than that? With how much you guys are paying? I mean, it's like, where's all the money going? Well, we'll find out for sure where the money is going. That's not going to be an issue. But the idea is why isn't it more? Why is there? So basically, this breaks down and shows you that there's other income. And primarily, it's state appropriations. And state appropriations is basically funding that New Jersey is providing. And that we'll see exactly how much that is. That turns out to be a really, really big chunk, right? In a way, of what's going on here. Any other big income items? Any other big income items? grants, contracts, auxiliary. Yeah. Well, they have a section for that comes from sports, from the contracts with networks. So now when we get to this is basically the statement of net position. And now what are you curious about here? How much does Rutgers have in assets? Can anybody tell me? How much do they have in assets? Yeah. Well, you gotta add the zeros because it's in thousands. Whenever they say it's in thousands, all you gotta do is add 3 more zeros. And and that's it. 3 more zeros on everything, and just you stay with that. So 4 billion is what they have in assets. It's a big organization, right? It's a large, and primarily where are their assets allocated? If you had to go from a top level, currently on the balance sheet, capital assets, right? Capital assets. I mean, topically, does that make sense? What kind of capital assets between Newark, New Brunswick? What are you talking about? Land and buildings, yeah. Like these buildings, in a way, they've constructed quite a few buildings. I remember I went to school in New Brunswick. I mean, that place is huge. I mean, they have like hundreds of buildings there. Here, I think it's a little bit smaller. They have, I don't know, but it's just not that vast. It seems like New Brunswick, it's a whole town's worth, or several. So that's buildings, primarily capital assets, and then they have some liabilities. Anybody have any idea who they owe money to? $1 billion. Bills, various capital projects, debt financing, asset, wages payable, salaries, things like that. Like things that they're financing right now. So is the balance sheet growing? Are the assets improving? Net assets improving over the years? Yeah. And in a way, this is a whole part of like really how do you run a university successfully, right? I think if you're thinking in those terms, like how do you make this happen in a way that things grow and things develop, right? And I think it's amazing what's going on at Rutgers. Some of the things I'm seeing, they have a lot of people involved in different things going on, but economic. A lot of it is economic. A lot of it is performance. A lot of it is based on growing and improving things. It's incredible because there's a lot of people here who are running all these different projects from the dean's office primarily, but also different committees and different people. So I thought it was interesting here they're talking about basically they're talking about some of the housing projects that they're investing the money into, basically what they're spending, what the current liabilities are. And basically this is part of reading financials, is that anything that you have on the balance sheet, you want to know, if you're basically auditing that financial, you will know everything what is composed of. So in a way, for the reader, you can find out what are the numbers being composed of. And if you've never done that before, I highly recommend doing that at least once, because in a way, that is what an audit product is. As the auditor, you basically are telling people what is on the balance sheet, but more from a footnote perspective, not from a number perspective. Like when I was auditing a company, it would be like, well, there's a payable for 1.6 billion. I would be able to just tell you what is in there. Not on like the super deep, but at least like on a pretty intelligent level. And that's basically the product. It's just like summarizing all these things, besides them being accurate, also knowing what is going on in the business, why that is. That's basically, it's a story. It's not just numbers in a way. Like I think with Rutgers, you guys can really relate that it's really a story. We're saying current assets over current liabilities is 1.7. What kind of ratio is that? Current assets over current liabilities? Current ratio. And the current ratio, it's at 1.7. What is that, Kenneth? So the idea is if the current ratio is a 1.7, how is your liquidity good? That's pretty good. Liquidity is good, In your own terms, that basically means that if your cash was at 20 and your credit card bill was at 10, it's pretty good, no? You can basically pay off your credit card and still have double, like a couple of them. And that's what they mean. So basically what they're saying is from a liquidity perspective, the university can cover 4 months of its operating expenses with just the cash that it has right now. And now we're going into the endowment. And in the endowment, how big is the endowment? Anybody know from the balance sheet? From before it said how big it is, no? Almost $1 billion, exactly. Almost $1 billion for an endowment. Is that a lot of money? That's not compared to Harvard, right? Harvard endowment is like $26-30 billion, and this is $1 billion, so it's a little bit, it's not a huge number, I would say, but at the same time, what was the investment return this year? Anybody know the investment return this year? It was about 11.3%. So, although the endowment is pretty small, the fact that we were able to make about 110 million of investment income, I think it's pretty amazing. I think it's pretty amazing to generate that much income in a way to pay bills, right? Or invest into buildings just from having the fund. Of course, at Harvard, where they, traditionally they make about 20% a year on their fund, and on $26 billion, what's 20%? It's about $5 billion. So in a way, Harvard, what are the net assets of Rutgers? Anybody know? What's the net assets at Rutgers University? $4 billion is the assets. What about net assets? 2.6 billion, right? And think about it, Harvard can generate up to $5 billion in just income from the endowment. So think about it, endowment is like, their annual income is bigger than our entire balance sheet. And they're a very small place. Think about it, that is a place that's very concentrated in one very small place. So in a way, think about it like how powerful it is to have an endowment. Like imagine Rutgers had a $10 billion endowment. I think in a way, the 10% on that, having $1 billion, you could technically pay off. Anybody know what's our biggest expense? Anybody know what's our biggest expense? So $1 billion, our instructional services cost $1 billion, $780,000 for instruction, basically for teaching. So imagine that you could pretty much pay off your teaching bill by just having an endowment. In a way, I think that's like why we hear a lot about these endowments at different colleges, because basically it's an incredible way to finance yourself and even finance buildings by just having something like a fund sponsor you. And then, that's, I think in a way, I think that's growing here dramatically, because there's also the foundation, which we'll go over. It's basically, no, that's a good question. It's basically kind of like a fund that collects all the charitable contributions to a university. Basically what they're doing is, I guess with the universities, there's a big aspect of giving, because essentially, I think the concept comes from with the fact they say you go to college, right, and you start, become a millionaire or a billionaire. Technically, you got your education at the college, right? So a lot of people who become millionaires, billionaires, almost automatically, I don't know automatically, but also they just traditionally give to the college. Sometimes large, very large amounts.
So it's like
it's a fund basically that collects the charitable contributions from alumni, but it could also be from organizations. That's that money back. In a way, what happens is with endowments, like that's where the money's coming from, right? And then what they do is they almost form like an asset management. That's like basically, I know about it because I was in the asset management industry. and endowments were sort of big in the asset management industry as clients. So I always read about what's going on there. It's a big part of asset management. So I always read about it. But in a way, what Rutgers does with it, like, you notice, like, it's very sophisticated. They have like an internal asset management team that manages the money like a hedge fund, basically. Is it an internal hedge fund, basically? And Harvard Endowment basically gets managed by like the best people in the world, like, because they always talk about it. They hire like the best people in the world to do it. In a way, it's like a big fund, and it's also, you know, it's also a bit, like the school itself has a lot of alumni. But in rich ones, basically, I mean, I don't know if, yeah, it's true, they're rich probably statistically, right? But it seems like some of the more successful ones are dropouts. What is the nature of the endowment and how it operates? I think it's really interesting because, like, just the nature of it. And I think I always enjoyed in the asset management industry reading about endowment investing because they were some of the biggest risk takers out there. From an investment profile perspective, I always noticed that endowments, they were not playing around at all. They're not like mutual funds or pension funds, that kind of traditional equity investors. I remember like reading a lot about Harvard, like they would go to Brazil and buy timber, or like they would buy like forests and be like, yeah, we just got some forests and we're gonna just have forests for a couple of years. And because timber has been going up in value like dramatically. And then they would trade on that, and they get these crazy returns trading forests in Brazil. Like, and I thought that was just interesting because they, you know, they do a lot of derivative swaps, hedge funds, exotic stuff on a large scale. So it's like, you know, it's interesting. You'll notice in these financials too, if you read on a more detailed level, you'll see in the back, if you're interested in the financial part, there's a lot of stuff about swaps, interest rate swaps, derivatives, various things that Rutgers is doing financially. You could see is a really sophisticated team somewhere in there in the finance level, because just from what I read, it looks like they're deploying really interesting strategies for different things. So you could see it's a very, very sophisticated institution financially. And you could also read through it, you can see that the complexity of this operation is also really, really vast. And, you know, and the resources are vast too. I mean, in a way, I think it's also interesting because most of the employees are successful PhDs. Think about it. Most of the employees of this institution are successful publishers, right? Because in a way, in university, the people who stay around are the people who manage to be published in journals over and over again. So basically, it's an interesting operation because the vast majority of employees are like published around the world in science, but you know, also like in business too, like especially in business school. So in a way, I think they're applying a lot of that science and a lot of those sort of skills into the operation. It's amazing. So we're talking about the changes in the quality of the assets. We're talking about the increase in spending on assets, 99.6 million in 2013 versus 203 million in 2012. And what they did was they completed the Livingston Apartments, Camden Housing, and some dorms on Camden. And they're also talking about that they were also funding construction of a new facility at the gateway of Livingston campus. I think a lot of these financials are also talking about the completion of 100 Rock. Anybody ever been at 100 Rockefeller? You guys really got here pretty much all the time. They keep you guys really like, you guys don't get it. They don't let you out of the building much. In a way, like, no, 100 Rock, you guys, like my last class also, like in a way, they build this like state-of-the-art building in 100, and if you Google it, you see it. It's kind of like a very modern building, and it kind of spans, it goes over a highway. It kind of looks like an L shape and hooks up to another building. It almost looks like something, you know, something like that would look like a museum or something. It's very modern, it's very interesting, and it's state-of-the-art. And even companies lease it. I found out I was at the Deloitte headquarters the other day, and they were saying, oh yeah, Deloitte is going to have their annual blah, blah, blah there. So it seems like it's one of those buildings that's like in demand in New Jersey to have events like when students are not there, like a Sunday night. So, and I taught there last spring, and it was like really incredible. Like it really felt like I was walking into the Met, or like, you know, like a thing in the Upper East Side or something in Manhattan. I was like, what is this? But this is like, I think in a way, like they're now investing into newer buildings and newer technology too. You could see that a little bit here also, I think, with this building being wired and everything. So how much did our net position increase, guys? 68 million this year, right? Not bad. That's good job to our president, right, Mr. Barkey? Barchi? Mr. Barchi. The president. It was so funny. I was at the faculty retreat. I noticed Rutgers. It's like my first thing when I kind of like saw how big the institution is. It's so funny that they have, I don't know, it's kind of like they have all these like layers of different offices. Like they have the dean's office, which overviews the faculty, and then they have the chancellor's office, which I think overviews the deans, and then there's the president's office that I think overviews the chancellor. But it's like, I'm like, well, it sounds like we're like in a government. It's like a government. It's like a whole its own government, no? Like it really has a pretty wide hierarchy and a pretty wide organization like that. It's really. I think they're gonna publish. Have you guys heard about this video they're making at Rutgers? We are business. Has that been affecting you guys at all? We are business. They're doing it in New Brunswick. They're filming this film about the business school, and they were doing it. And I did a thing. So if it comes out, I talk about advanced accounting, about, you know, and I think they're putting it together in terms of what is each instructor is doing in the business school. I think they're just like, the communications department in New Brunswick is like making this movie. It's like interesting about how they're like sponsoring this thing. So anyway, we're going into expenses, and like this really breaks down, like you saw on the expense side that it's 1.9 million. But then if you wanted to know more detail, like this is basically providing the detail for you guys in terms of what is the expense. And are you guys curious about any of these numbers? Any curiosity, like construction? Instruction? Yeah, instruction, right? Oh, about 50%. Students, yeah, isn't it interesting that student services is only 10%? I was gonna see if you guys can get angry about that. You guys are the whole school. Should be more than 10%. What kind of services do they provide to you? There's no hot water in the showers at the gym. I know that from earlier today. I'm sure it's fixed by now. I'm sure. No, but the idea, I think, like in a way, like some of these numbers should, like in a way, I'm curious, like what's going on, especially with research. I think only 10% for research. Also, I thought this is kind of like a scientific organization, really. Like, you know, we're based on publishing science, and with sponsored research is only 10% of the entire expense. So I think that I'm curious how they're coming up with these numbers too. Like the allocation, are they allocating salaries? Are they allocating departmental budgets? Like how are they coming up? You know, I would have a question like what is the cost allocation methodology for some of these? Because I don't know if this is the right number. I mean, I'm sure it's the right number, but I don't know how they got it. And I think it will suit you well, really, guys. I remember in staff training, in audit, and then when I used to be an instructor in that a little bit, this is what you always tell people, and they always told you, is ask a lot of questions. Ask a lot of questions. And in a way, I never knew, like, why he just keep saying this thing over and over again, like, ask a lot of, you know, and I realized that later when staff would get into a lot of trouble with the seniors, when there was, like, a lot of tension, because people would sit there sometimes, the junior staff would sit there sometimes for, like, a week, and then we come back, or the senior comes back, he's like, so what's going on? And they didn't do anything. And now the pressure is on you, and you're like, well, why didn't you do anything? He's like, well, I didn't know what I was doing. Like, oh, well, why didn't you say anything? I was like, oh, I didn't know. And that's when it was like the big, that's the asking questions. Is like, if you don't know something, you got to ask. Because otherwise, later, it's going to become apparent that you didn't know, and then they're going to, it's going to become a different thing than just asking. And in a way, asking questions, like as silly as it sounds, like ask questions. Like, how did you guys figure that out? In advance, lets you be like, oh, now I can do what I need to do. I can get this out of the way. And you just like move on to the next thing. And I think, I remember it's like a really good thing to do. So what I want to do now, so basically this is the report. I kind of wanted you guys, I wanted to get through the notes. We don't really have the time today to really get to the notes. But I want you guys to keep this report. And I'm going to go over now in the PowerPoint. The way I designed this class is, like I said, the main sections are these 3-4 accounting topics that I'm going over now. And then the book for 10-15 pages, it has an example of a financial report. So instead of you guys really reading this whole chapter, studying the whole chapter, you can only study these 3-4 topics that I'm going to go over now and keep this report as the financial example, because the book has one for a university and for a government, but use this as your university and government because the mode is the same Gatsby. So Rutgers is like a quasi-government in a way. So you can use this. So keep this as the handout, the study guide, and you can continue using that over the next 2 weeks, especially for your review. And for the chapter itself, what I'm going to go over now is really going to be the 3-4 topics that we actually have to study. This is basically the second half of the PowerPoint that we already did, where it talks about the distinct sections of the financial report. Basically, you want to know the MDMA, the actual financial statements, the notes that are financial statements. Very important is the notes and the required supplementary information. So the 4 topics we're going to go over now is the theoretical study of this whole kind of application of governmental accounting is going to be leases, capital lease, right? We're going to go over depreciating landfills, recording landfills in our books and records. We're going to go over the recording of historical treasures and art pieces. And then we're going to go over the defined benefit pension plan liability recording. And this is all stuff in a way that's very pertinent, very material to governments. This is why we're going over, because this is in a way governments really deal with these issues on a deeper level. So the first one we're going to go over capital leases. Capital leases, basically governments deploy these capital leases sometimes instead of owning something, they would rather lease it. I don't know if we own this building or lease it. Anybody know this is a lease or doesn't matter. But basically, in a way with leasing, you have less cash outflow right now. Instead of buying a building for $100 million, you lease it for $7 million a year for 10 years. So that way, your $100 million can remain as a balance sheet. I personally like this way for everything because I'd much rather have a stronger balance sheet with a lot of different cash flows and outflows rather than a heavy balance sheet full of assets but no cash. Because if you have no cash, you're not really nimble. You can't really buy anything new, right? As opposed to if you have a big balance sheet and you're maybe buying things, you might be buying and selling little things all the time, but at least if you need funds to pay a bill, you could always pay a bill. So you're not in distress. This is 17. Yeah, 17 we're doing today. So this is essentially a capital lease. When you record a capital lease, you debit capital asset. Say it's like say a truck. You debit truck, right? You debit lease on a truck, and you credit lease obligation on a truck. Because when you get a truck, in a way, you're gonna have to pay off this entire thing, the 70,000, say over 10 years. So you credit that as a liability. and then say every payment on the truck that you make, it's $10,000, it's going to be debit the lease obligation, credit cash. So these are the main two journal entries. First of all, you record it as recording an obligation and an asset. And second of all, every payment reduces the liability because now you owe less on the lease. You had a lease this big, you pay it off a little bit, now you're going to have less lease. And then at the end of the lease, you're going to have no more payments. So the only question is like, which kind of payments are you making? You're making principal payments, which reduces the lease obligation amount, and then you're making interest payments. Interest payments basically, because in a way you borrowed the money, you're kind of paying a little interest on that aspect. It's not a lot, but it's going to be a little interest every time. Now this one is recognize the liability caused by the eventual closure and post-closure cost of operating a solid waste landfill. So for solid waste landfills, what we have is, it's kind of like when we did an intermediate 2, we talked about mining a little bit. When we talked about depreciation, depletion, remember there's a little mining piece to it when we like closed the gold mine. It's kind of like that. Say the landfill is going to cost $1 million to clean up. You clean it up for $1 million. Well, we already know it's going to cost $1 million. So even on year 1, say in 5 years we're going to pay the $1 million. On year 1, we already record a $200,000 liability to close off the landfill. So we basically have these expense landfill closure and then liability landfill closure. So this is something that we record. And then every time you actually make payments toward the landfill closure, you have landfill closure liability debited. Because you're making a cash payment, you're going to reduce the liability. And you credit the cash. The cash comes out as it comes along. So this is basically a way for us to record the liability in advance and then start paying it off. Oh, and I want you guys, this is a subtle distinction here. If you look, and this is, we've been talking about this, governmental wide, I start looking at these big picture things like the liability. And notice in the fund itself, I only record the expense, because in the funds, remember, we don't really accrue these assets and liabilities. In the funds, we're just concerned, what did you spend right now? So the fund just has the 30,000, it doesn't have anything else. And this is the focus with funds, I think in general, you guys should record. It's just talking about how much did you spend, and they don't hold any assets besides cash and liquid investments. If it was an asset, they would have just paid for it. Right? It's modified, it's like modified approach. So we're going to go over this one. Explain the reporting of a net pension liability resulting from a defined benefit pension plan provided to employees by state or local government. So I wanted to go over the example with you guys. This is kind of a big issue in general, like in the news with governments. And the issue is that the net obligation on pensions is becoming negative. And what is the net obligation? Net liability is basically, say you guys were all about to receive a pension, and I'm a fund that's going to give you a pension. I'm going to give you $40,000 a year for the rest of your life. So, say 50 years, for the next 50 years. So that means if I'm giving you $40,000 a year for the next 50 years, there's 50 of you, so it's $2 million a year times 50. So I owe $100 million over the course of 50 years, right? Then I would discount it, right? Because I owe $100 million over the next 50 years, but it's $2 million a year. So imagine in Excel, I just put $2 million in every cell for about 50 cells, right? And then I would discount each one of those cells by 1 over 1 to the n, where n is the year I'm in. So 1 over 2 million divided by 1.1 plus 2 million divided by 1.1 squared, plus 2 million divided by 1.1 to the 50th. And that way I have a present value sum of all the future payments to today. And say that number is 40 million. So today I can say with confidence, like, I owe 40 million in the next 50 years to you guys. And then on the asset side, I'm going to look at my portfolio of investments. Say I have a $50 million in there, and I'm earning on it, like, say, 2 million a year. And I would say, well, that 2 million is really 2 million times 1.1 next year, because I earn about 10%. And in 2 years, that's 2 million times 1.1 squared. And in 50 years, the 2 million is 1.1 times 2 million times 1.1 to the 50th, right? Because every year it kind of increases the exponential factor by 1. But the issue, what is the negative pension obligation if the first one is bigger than the second one? If I owe more, like I'm saying, like, I owe these guys more, I owe 40 million, but my fund investment return is 30 million. You know, all about the present value of future cash flows. So now I have a negative 10. That's basically what they're talking about. They're talking about a liability, and it's a little complex because, you know, you have to go through this part. This is the easy version. Then you get the actuarial and like life expectancies and health expectancies and portfolios. It's insane. But this is the easy example just to give you a flavor of where we are. And then it's negative. And if you look in the book, it's also talking about why it's negative is because a lot of universities and a lot of states are using an investment and return assumption of 7.5%, where the actual return number is 3.9. That's what people are averaging. So in a way, they're exaggerating the investment return, and in a way they're hiding this deficit that's really underlying. You know, and with funds like Social Security, there's no more hiding because in a way by 2060 we're not going to have the funds. So in a way, once you run out of funds, you can't hide it anymore. But this is the gap that we're dealing with, is that percentage. But think about what is 2 million times 1.039 versus 2 million times 0.39 to the 50th. And now replace the 0.039 with 0.075. Think about the exponential impact of the percentages when you have an exponent of 50 next to it. And that's the kind of things that we, like when we project Social Security, the viability of Social Security or the viability of New Jersey Teacher Trust, that's the kind of numbers that we have to run. You know, and in a way, this is really talking about how to calculate this number. And I don't think we go through the whole thing, but we really just talk about that specific part of where the government's right now, where the issue is. And that's the heart of the issue, is the percentage assumption. And also that there's a lot of deficits that people know about in different cities and governments and states. So this one is the last one I think we're going to go over. And this is about, oh no, there's one more. And then we're going to do the workshop in a few minutes, guys. I want you guys, in a way, like whatever you've gathered so far, I want you guys in a few minutes really discuss with your team, you know, really present what you have, really like take this time to practice the business communication aspect of things, really share how you found it in the footnotes, you know, and listen, you know, try to really listen to what your teammates are talking about. You know, they may have something really important to contribute to really help you understand the report in a whole other way, you know, maybe another angle. So in a few minutes, I'll give you guys time, and if you have any questions, I'll come around and show you guys where it is in the report to go over. So in terms of art, we basically record the art and the historical treasures as a capital asset, right? And then the question is, do we depreciate it? Do we depreciate it when we get it? So the idea is if we have something like in our possession, like the Mona Lisa, do we actually go through and figure out the life expectancy of a piece of, what do you guys think, like the painting? Does it have a definite life? Is the Mona Lisa going to expire? But I heard they retouch it sometimes, like... No, I'm just kidding. I'm just kidding. No, it doesn't expire, right? So there's no useful life. So basically it stays on there at its original fair market value or the cost if it was purchased. And that's the idea, the way you record it. So in terms of infrastructure assets and depreciation, what we're talking about here is depreciating long-lived assets. And I think, really the point here is about the government possessing these really long-dated assets. And the example of Brooklyn Bridge is it was built in 1883, and the Brooklyn Bridge cost $15 million to build that back then in the end of the 19th century. And it's still operating to this day, and it cost $15 million. So over 130 years, how do you depreciate the $15 million cost basis? And in a way, what we're talking about is using the modified approach, which basically says it's not going to be a useful life of like 5-10 years. It's going to be much longer than that. And then what you got to do is you got to really document the state of the asset. How much is it being maintained each year, and what the improvements are being, are they being capitalized or are they being expensed? And then you can use the modified approach with longer life expectancy, like with the Brooklyn Bridge. And the idea here is that oftentimes what they end up doing is instead of depreciating the asset, they record maintenance, like improvements, as expense. So instead of depreciating, because how does the bridge, you don't really know how much of it is expired. So in a way, instead of that, every time they're fixing like the Pulaski's Highway, every time they're fixing the turnpike, they record that as debit expense, highway maintenance, credit cash, instead of even depreciating, because depreciation doesn't really approximate, honestly, the matching principle. The depreciation idea is the matching principle that you're regaining the usefulness of the asset through expensing it over its useful life. But if that doesn't really apply, then you just, you use the maintenance amount as the expense itself, because that's what makes the asset continue to live longer, right? So now the section is like the rest of the half of the class, the PowerPoint, is talking about the structure of the comprehensive annual financial report. And this is what I kind of want you guys, I know you guys have been working on this throughout the class, but really work with your team now, really present your findings, use this time to really discuss and collaborate with each other, and go over primarily the 3 distinct sections: the management discussion and analysis, the financial statements. In a way, look at the 2 sets. They have the net position and the revenue and expense statements that you want to go through. And also look at the notes to the financial statements and required supplementary information.